Well, the U.S. dollar has been gaining ground recently as investors rethink how quickly the American Federal Reserve cuts interest rates. There's a growing belief, based on some of the inflation trends we've been talking about, that the Fed will have to wait until at least later this year to start cutting rates. Speaking of later this year, there is a presidential election on the horizon stateside, and our next guest says the political showdown later this year could be a positive catalyst for the greenback. Daniel Tobon is a currency strategist serving as head of G10 FX Strategy at Citi Research, and he joins us this morning. Daniel, nice to have you with us. Everybody's busy talking about the Fed this and the Fed that, but you're starting to think ahead to the election itself. How come?
Yeah, and absolutely. Right now, in the short term, we would say the Fed is the biggest driver for the dollar. But as we start moving closer to the election, we think that's actually going to have a bigger impact. First of all, because we'll probably have a lot more resolution on what the Fed is actually likely to do, but also because markets tend to start trading U.S. elections a couple of months into the event. So we think as we head into the late summer, we'll start having markets more broadly, not just the dollar, start focusing more on the election itself. And I should just note our new must-see flagship report out of Citi just came out, including commentary from our Washington, D.C. correspondents. And we look at a lot of different asset classes. I think the dollar is really interesting because, you know, pre-Trump, the dollar actually did not move that much to U.S. elections. But in the Trump environment, the dollar has become a lot more sensitive for a couple of reasons. One is that tariffs are now a bigger topic and a political tool, and the currency tends to be very, very sensitive to tariffs. And two is that fiscal has become a much bigger issue as well, especially in recent years. And both of those topics are actually going to be very relevant for this election. And so we think there's potential for the dollar to rally up to 5% just based on the election. And as I said, I think we'll actually rally into the election and potentially even see the highs in the dollar around the election itself, regardless of the outcome.
Daniel, when we're trying to explain to our audience why currencies gain against others or weaken against others, we try to sort of explain the dynamics. We often tell that story through what's happening with the economy. And, you know, in very simple terms, if interest rates stay higher, that creates typically some strength for the American currency. And that's why every time we keep talking about Fed rate cuts getting pushed out, people come back to the U.S. dollar. That might mean some short-term weakness, say, for our Canadian dollar. When it comes to the election outcomes, can you walk us through the specific headline and why that leads to sort of a reaction in the U.S. dollar? For example, if you were going to see some strengthening in the greenback associated with the election, what are the mechanics behind that?
Yeah, so there's really two that we would focus on. First, there's the tariff side of things. As you start seeing tariffs imposed on other nations, it means that our imports get more expensive. So you have inflationary pressure, which then leads to higher yields. There's also a component of it where you could see some weakening of the currency where the tariffs are being imposed as they adjust to the fact that their exports just became more expensive. So in general, what you'll be looking for is which countries are these tariffs being placed on. Those currencies are the ones that are most likely to weaken versus the country imposing the tariffs. Now, in this case, you know, what we've heard so far, and this doesn't necessarily mean it's going to be the policy, but what's being rumored so far is 10% tariffs on all imports into the U.S. and 60% tariffs from China. And so when you put it that way, the most vulnerable currency here actually looks to be the Chinese renminbi. So we do have a bearish view on that currency into the election.
Now,
so tariffs is, yeah, sorry, go ahead.
No, please finish your thought. Please go ahead.
Yeah, then the other is the fiscal side. And especially as we've seen in the last couple of years, fiscal deficits have become a much bigger story. Really, it's not just about the White House, though. It's also what happens with Congress overall. Whenever we see a divided Congress, you tend to see fixed income perform a little better. That is, yields don't really go higher because you have this situation in Congress where it's going to be a stalemate and not much gets done. If we see a situation where it looks like one party will have full control of Congress, and in this case, if it's going to happen, it looks more likely to be the Republican side, then you have a united government. You're able to get a lot more done on the fiscal side. In this case, we would expect it to be on the tax cut side. That means higher yields, both because of the bigger fiscal deficit, but also because tax cuts are growth positive. So
Right.
again, yields higher in the U.S., dollar positive. So there is a component to it, which is what you were talking about, which is the yield side.
This is really helpful. Daniel, we're almost out of time, but for people who are considering this on the investing side, it's interesting for practical reasons. A lot of Canadians are very curious because if the U.S. dollar is going to, for example, strengthen against the loonie, they've got to consider that for everything. Their travel, even if they're owning stocks in the United States versus in Canada. It's been a long time since we had a conversation around parity, but even a conversation around an 80-cent loonie against the greenback. We'd started to see a trend higher for the Canadian currency recently because there was this belief that the Fed was going to start cutting rates, even though there's a parallel conversation here in Canada. Based on everything you're saying, though, it sounds like there could be a cap on upside for a currency like the loonie if investors gravitate towards the U.S. currency. What would you say to that quickly?
Yeah, I would say that I agree with that, but I would think that that's more of a trade for the second half of the year. If anything, we think there could be some mean reversion in Q2. So you might actually get a little bit of a stronger loonie in Q2. But I think that the second half of the year is going to be much more dominated by this election theme, and that'll see the greenback strength resume broadly against everything, and the loonie won't be immune to that.